Well, welcome. Thank you so much for having us and this great esteemed panel, which I'm going to introduce first for the future of housing demand. That's our topic today, and that's a tough one, I will say, because I think it's very important that we look at the current state of housing demand, which is incredibly unique right now, given the two cohorts that are fueling that demand. And it's not first-time home buyers. It's, as we all know, investors and other move-up buyers trying to get into the market. But I'd like to introduce the panel first. I'll start down on the end there. Mr. Calabria, Mark Calabria is Director of Financial Regulation Studies at Cato. Just to my left is Eric Belsky. He is Managing Director of the Joint Center for Housing Studies at Harvard. Moving here, Douglas Holtz-Eakin. He is the President of the American Action Forum. We have Richard Smith right next to him, Chairman, CEO, and President of Realogy Holdings. And at the very end, Jerry Howard from the National Association of Home Builders. We are going to talk a lot about that, home building. CEO of the Home Builders. So let's start. I want to keep this conversation as informal as possible. If you all don't agree with each other, please speak up and let's get the conversation going. As I wanted to start first is about specifically when we talk about the future of housing demand, we have to look at the unique situation we're in right now. And again, that is a highly investor-driven market, especially in those markets that Stan was talking about, where we're seeing huge price appreciation in Arizona, Nevada, California, et cetera. And what I want to talk about is how that demand is going to play out now when we move into where housing's demand in the future goes. And I think I'll start with the real estate agents and start with Realogy. Maybe you can answer my first question, which is, when you see demand out there among your agents, among the people that you work with, how much are investors pushing regular, organic demand out of the housing market?
Well, let me dismiss this thought that this is an investor-driven market. It's not.
Okay.
There are about 5 million homes that will be sold this year. I think the current count is 50 to 60,000 of them are investor-based. The largest investor has acquired 16 to 20,000 units. That's not going to have a material impact on the market more broadly. It will certainly have an impact on specific markets, that, for example, Phoenix, or in some cases Miami. But in the broad sense, it's not having the impact that the media would suggest. Let me give you an example. We're the largest REO reseller in the United States. During the best of times, our REO assets, and these are bank-held homes, are broken out 60-40. 60% are going to mom and dad, traditional FHA financing, and the balance to investors who are local, small, family-owned investment groups, not institutional investors. Currently, and this is the extreme in the market, it's 75-25. So it's not as dramatic as one might think. And bear in mind, that is in 12 markets in the United States. So it's not as robust as one might think. We actually think it's a positive. Investors are taking assets that are not performing. They're refurbishing these homes, putting them back into the market, so they're creating economic value. And we view that as a very strong positive, not a negative. So.
Well, I would actually move the question on to Mr. Howard, because when we've talked to a lot of home builders, not just out west, but throughout the country, they are seeing increasing demand from organic, regular home buyers, because these buyers say they've been pushed out of the market by all cash investors, whether it be institutional, whether it be this new REO to rent asset class. But builders specifically that I've spoken to in Nevada and Arizona have said they didn't expect this much demand, but the demand is coming to them from people who can't get into that distressed market, and the builders are trying to catch up. From your perspective, did you expect to see this kind of demand this fast that builders are seeing now?
I think we expected to see investment demand for housing in the markets that had been the hot markets prior to the housing downturn. So I really kind of agree with Richard that in some of those markets, the demand from investors is going to be a much more significant factor than in others. In fact, I just got back last night from Florida, and in some of the Florida markets, it's exactly as you're saying, but in others, for example, Tallahassee, you're seeing family formation, kids getting out of the colleges there that are staying in town, and they're sort of driving the demand. Family formation is coming back up and ramping up to more normal levels, and that produces demand at the first-time homebuyer level, and I think we're starting to see that in a lot of places.
I'd like to bring it, you're nodding very.
Oh, I think
yeah,
that's the key. I mean, I've always thought the investor issue is just a timing issue. I mean, what ultimately matters is, people, the demography of the U.S., the number of people, the headship rates, household formation, the prices they have to pay, including interest costs and things, and then their purchasing power. And I think the foundation, the demography is starting to come back. And we had 500,000 homes formed a couple years ago, really low. We're back to 1 million. It's going to go north at some point. So that part's the good news part. The part I'm worried about is the purchasing power piece. This has not been a recovery characterized by a lot of income growth. And Stan had that great chart that showed, it's a ratio of home prices to income. I think more of the discussion should be about the denominator. The median income's going down, and that's the problem.
And that's actually really interesting because this morning Fitch just put out a report saying that U.S. home prices were overvalued by 10%, which I mean is a surprising thing to hear when we talk about how far home prices have fallen. And I'd like to bring the discussion over here. When we talk about this incredible home price appreciation we've seen over the last year, and yet income growth is not keeping pace. We've seen wages stagnate. Does that concern you that we are, and I hate to use that word, but it's in the LA Times this morning, frothy?
Well, I think, we heard a couple of people talking about what's really actually going on in the marketplace. There's no question that prices are up significantly in some of the hardest hit markets, but when you look at where they are relative to where their peaks were, take a market like Phoenix, which I guess is the poster child for this, it's still off dramatically from its peak. It's
but can
still,
you compare those when those were
lower.
Unsustainable? I mean, that was
Right, no, but even in a long-term context, housing in Phoenix is, quite affordable. When you look at what it would cost to rent a place in Phoenix, a lot of people just do the comparison. They look at what they can buy a house for, they look at what they can rent a house for, and it's an attractive comparison. So people are starting to get into the market again because I think part of it is the fear's gone. That prices are going to fall. No one wants to, get into a market where they think they could have bought it less a week, or two later. So you have this, surge of demand that I think we're starting to see clearly coming online. I think the spring buying season is going to be a strong one, and I think it's because, to the point that Stan made, it's very affordable in terms of interest rates. But even when you back out interest rates in these markets, and again, you could see it in the chart. You'd have to see interest rates go a long way up before this would not be an affordable marketplace to be in, because prices are still quite low. And so I don't see a problem this year. The question will be whether we see those levels of sort of double-digit price inflation continue in these markets. For this year, Stan's expecting a slowdown. I think a lot of us are, because we think that what's going to happen is some of the investors in a market like that are going to come out of the market as prices go up, although they're still in the market because they still think they can make money in this current environment. It's penciling out for them. But eventually buyers are going to start to get into that market because they're the key part of the market that's been on the sidelines.
Well, when we talk about incredible affordability today and that it's a good time to buy, let's talk finally about housing's future. And the question of, with these incredible low interest rates and with home prices as low as they are we in fact, with these, as I will say, government subsidized low interest rates, stealing demand from the future?
I think to an extent we are. I mean, I would start from the observation it's hard to imagine rates getting any lower, and it's hard to imagine rates staying at these low levels for an indefinite period of time. So I could certainly see 2 to 3 years mortgage rates start to get close to 6–7%. And of course, if you start to get there, you're going to start to see a dampener on house price appreciation. But it's back to, I think, that fundamental question. I do want to echo income growth is a very big part of this. Once interest rates start to go up, despite the fact that you have a very large number of cash borrowers, if it looks like that price appreciation is going to start leveling off, I think you're going to start to see investor demand weaken considerably. And so the question just then becomes, are you going to have all this other demand coming from pent-up demand, which I do believe is there. So I think it's important to separate out. You can certainly have a very healthy housing market like Phoenix where there will be turnover with little price appreciation. So a question, I'd characterize it this way: a shift from investment demand to more basic consumption demand, which I think is probably more sustainable over the long run. But I'm certainly very concerned about when rates go up, combined with, are we going to see income growth? And quite frankly, right now, it's hard for me to see where we're going to see strong income growth come from in the near future. And it's also important to keep in mind, you buy your house essentially, I mean, yes, considering mortgage interest and all these things, you buy your house with after-tax dollars. So, deficits are future taxes. So to the extent that that lowers after purchasing power, that's going to have a drag if we don't address our long-term fiscal issues as well.
Does anyone agree with the premise on this panel that home prices are overvalued? But Fitch's, no, everybody shake their head.
Can I just speak for that a moment? There are a couple governors that exist today that didn't exist during pre-bubble. In the underwriting process today, the underwriting is substantially different than any we have ever seen in the history of housing. The appraisers today are viewed in a very different light than they were pre-bubble. They actually paid attention to. So if that property doesn't appraise, it's unlikely you're to get financing, and that's even with an 80-20 loan. And I don't see that going away. So when you look at underwriting coupled with, I think, very efficient appraisal process, it's unlikely that you're going to see frothy markets. I'm a believer in the market. The housing market will determine what price is appropriate. And in a downturn, we can all paint it with the same brush. It's all negative. We can all sit up here and talk about a national real estate market. In recovery, that is gone. You saw it in Stan's presentation. In a recovery, the market's return is a regression to the norm. Everything's driven by local dynamics, not the national dynamics, and that includes pricing. So it's what the market will bear.
And I would add another governor here is the qualified mortgage definition, which was also mentioned by Senator Isaacson. And so it's harder for prices to become really unhinged from income because it's going to be capped out at 43%. Now that's not just housing, it includes other debts and obligations. But when you look at how much people are spending for housing on average, it's well below that. And when you look at the extent to which people allocate income towards housing, that's been on a secular uptrend for 40 years. So I think there's still a lot of lift left in this market. It'd be hard for me to see any particular place that looks now, overvalued. And as I said, it's like when we were in a previous situation, when you start seeing, prices going up at 25% year over year, it's obviously going to cause, concern. The question is whether it continues to be at that rate. And remember, since they fell about 50%, it means they've only come up about 15% from where they were. So there's still just a lot of updraft in those markets.
So I want to beat a dead horse. I mean, I really do. I mean, so take the negative equity piece and put that aside, because wealth is important. So for house prices, put that aside. The rest is all about income growth, because whether something's, house prices are too high or not is all relative to what you think the future of income growth is. That's the only thing that matters. And on the pricing side, the future is all relatively bad news. It is higher interest rates, not lower interest rates. It is higher capital gains tax rates, not lower capital gains tax rates. It is a credit box that is tighter than it was before. Our estimates are 20% tighter than during sort of the 2001, 2003 era. So on the price side, it's all bad news. It's all about income growth and whether we're going to generate the income growth to support the pricing and the sort of organic demand that people worry about, and nothing else.
But I think again, that's a long run. It's a long run issue what you're talking about now, and I guess I'm thinking about talking about what's happening in the next.
Given that median incomes have fallen in this recovery, I think the long run is here. I mean, I think.
No, I understand what you're saying. I'm just saying that where we are now, it goes back to more the reversion to the mean point that Richard is talking about. So I still think there's room to do that. I think yes, long term, there's no question. Median real incomes fell over the last decade, and they're not going much of anywhere now. So,
I want to make a point about the froth, and certainly I'll preface with, obviously every market is very different. So I don't think there's froth nationally, but I would be concerned about certain markets. And the point I want to make is we go back to our Econ 101 and remember, it's not the average buyer who sets prices, it's the marginal buyer who sets prices. And right now in many of these markets, the marginal buyer is somebody who's got an equity fund, they've got cash. They're not the credit constrained part, and they're also looking at it and saying, there's nowhere else I can really put my money in this market. I'm not going to put it in the T-bills. I'm not going to put anything else. Everything else sucks. Relative, this looks like a decent investment. So I do worry that, when interest rates start to go up, other investments start to look attractive, that this marginal money And then, so my point would be, I think when we see a change in who the marginal buyer is, from the marginal buyer being a largely cash buyer who's simply looking at the investment return, to a buyer who has to live under QRM.
They're saying they're not running the market. They're saying this investment, this new asset class.
And in certain markets, I think in Phoenix, I think the marginal buyer is the investor, not the pure consumer. And so my point being is, I think at some point we're going to get to a market where the marginal buyer is a consumption buyer rather than an investor buyer, and I think that changes the dynamic a little bit.
And that's a traditional market.
Yeah, that's just the way the market works.
Yeah.
Listen, we're 26% U.S. market share. The vast majority of my buyers are mom and dad, or the single person buying their first home. It's not the investor. All this investor hype is just that. It's having an impact in select markets. More broadly, it's not having the impact, except we all talk about it, and it raises values in those specific markets. But generally speaking, this is it truly is returning to a normal market. You're subject to very different underwriting. You're subject to very different inventory constraints, and that's driving price, and that's the way the market works. It's not the investor driving value, it's inventory levels.
But investors aren't necessarily buying through real estate agents. I mean, they're buying directly from the banks in bulk, in deals.
Extraordinarily rare.
That's
and
right.
I represent the vast majority of them. In fact, they're through that inventory. That inventory doesn't exist. They are literally now buying retail.
So what about the fact that foreclosure starts are beginning to rise again after falling dramatically over the last
Well,
couple of
there's
years?
foreclosures.
I mean, that supply is coming
Yeah,
back,
but-
because you can't talk about demand, as I wanted to move
Well,
this
remember,
into, without supply.
banks are under a lot of pressure not to foreclose. They're not under
Right.
that pressure now. So
Right.
now they are back in the normal cycle of
They've paid
foreclosing
it
on
off.
homes that should have been foreclosed on 2 or 3 years ago, or even longer. Also, banks are now realizing if they put inventory in the market, they don't have to discount it. They can sell at retail and get a price. They've already written these assets off. If they can put it to market and get a retail price that's up 6, 7, 8, 9, 10, 11, 12, 15%, that's what they're doing. And we're getting those listings. So I know full well how the banks are reacting to the market, and that's how they're reacting.
Investors are also part of just how the market's coming back into equilibrium, because obviously, you know, the vast majority of people, and they are mostly small buyers, they're not the institutional buyers. But when you look at how many homes have actually gone through a foreclosure process, come out the other side, it's probably around 5 million homes over the last 4 or 5 years. And most of them, you know, about half of them, I'd say 2.5 million, made their way onto the rental market as single-family rentals. And that has kept inventories down in the for sale side. So it is, I think, contributing to this, you know, rapid growth in pricing. I do think they've taken things off the market, put them into occupied rental units. When you look at single-family vacancy rates for rental, they're actually continuing to go down. So the market's basically absorbed 2.5 million plus units, and investors were the mechanism that facilitated that process. That has, however, as I said, kept inventories of homes for sale lean, and the reason we're getting the price increases, and we all understand that, is that these inventories are lean. So you have to ask yourself the question why. Many of them found their ways to the rental market, and then now you have demand coming up from bona fide, you know, home buyers who have always been the largest part of this market.
Well, the
I
other
wanna
reason that
emphasize
demand
that.
is that nothing has been built.
Yes, right.
Quite simply,
Exactly.
nothing has been built for the last 4 years.
Why is that? Why is that now? Why are builders not
Well, right
able
now,
to
builders
get these?
are having a very difficult time, even in the housing markets where there's a healthy market, healthy demand, and a real need for supply. Credit isn't available. The banks feel constrained by the potential imposition of the Dodd-Frank regulations, the potential imposition of the Basel Accord, and the community banks are just, they don't know what the rules of the game are. So builders are having a very difficult time getting any credit for acquisition, development, and construction.
And land and labor.
And then the cost, meanwhile, as the production does start to rise, the suppliers from everything from timber to gypsum had scaled down their production. They haven't brought it back up yet. So material costs are going higher, which is also adding, by the way, to the price of housing. So the market has been out of equilibrium virtually in every facet for the last 4 or 5 years, and it's going to take a while for all these elements to get back aligned.
Yes to that, but I also just want to just emphasize this rental piece. And we talk a lot about the owner-occupied housing sector as if it existed in a vacuum. It doesn't. We've seen an extraordinary number of people enter into rental housing over the past 2.5, 3 years,
Record
and
numbers
record
over
high
a decade.
rents. And you know, the open question then is, how fast does rental housing get built, single family, multifamily, and how does that affect the transition to the organic demand in the residential housing sector?
but the
I mean,
concern is, I
that's a
mean-
big part of getting from where we are, which is unusual, to what the future
You
looks
had
like.
multifamily starts this month, just reported this week, up 82% in apartment construction from a year ago. And the concern then becomes, if these aren't coming onto the market for 2 to 3 years, because these are starts, are we going to have a bubble in rental supply because people start moving back into home purchasing, which is what everyone seems to be saying here. But I want to get to this idea of supply.
Yeah.
We talk about very constrained supplies, and specifically in some of what were the hottest markets and then the boom to bust markets. But if you look across the nation, inventories are down in cities that never saw big housing
Yeah.
booms. It is not just in California and Arizona and Florida that inventory is so low. It is absolutely everywhere. And my question to any one of you is, why is the organic home seller, the regular person who is not underwater on their home, because not everyone is underwater right now, why is everyone so afraid to put their house on the market for sale? Is it that they're afraid they're not going to find anything to buy, or is it they still don't believe that housing is still fully recovered? And any one of you can jump in here.
Well, the credit constraints at the front end of the pipeline, AD&C that we talked about a second ago, are there, but they're still there at the back end of the pipeline. Consumer credit, although you're reading in the press that it's getting looser, still isn't back to the standards that I think we would all agree was a normal functioning market in the early 2000s. So it's very difficult for a potential home buyer to get the credit that they want. And at the same time, it's difficult for a builder to get credit to build a house, and that's why supply is an issue.
It's interesting because Trulia just did a survey yesterday, and it's something like a third of sellers, thought that now was a good time to sell relative to what it would be like next year. And if you ask people if they thought it was a good time to buy, it was more like 80% thought it was a good time to buy. So you have this disconnect between buyers who think this is the moment to get in the market and sellers who think, well, maybe I should wait now if prices are going up and see prices go up. Plus, some of those sellers, if they don't have negative net equity, they may be very close. They still might have to write a check at the closing table to cover closing costs. And in addition, they themselves don't have to go out into this incredibly prohibitive market for getting credit and get a loan. And they look at it and they go, well, my credit score is not that great, or in the end, I'm not going to be able to put as large a down payment as I'm going to need to, and maybe this just isn't the best time for me. Maybe I should just stay put. And some of them may not have jobs still.
And we're seeing real estate agents now. This is interesting because I got one myself, and my producer out in Virginia got one as a card from real estate agents saying, what would get you to sell your home? And
Yeah, I mean, Zillow does something similar to that as well. What would it take to encourage you to move?
Make
So,
me move.
Make me
listen,
move, right.
this is the old-fashioned process in the business of knocking on doors and letting the homeowner know that the value they expect they can actually achieve if they were willing. So, I mean, I think Eric's right. People are of the mindset, if I sell now, I may get 5 or 6% up on my mortgage. Maybe I wait a year and get 10, 11, 12% or 15%. We see that as a dynamic that is playing out in most markets. We also see the more relevant dynamic, and that is, where am I going to go when I sell? So in New York City, as an example, anybody here from the city, there's literally no inventory. San Francisco proper, no inventory. There's literally days of inventory. You give me a listing in New York City, it's gone before the day is out, and I'll get full price and 5 offers. Right now, 55% of all of our transactions have multiple offers, and generally that's playing out in the markets you would expect. So there's extraordinary demand. The demand is simply outstripping supply. You're right, supply is going to catch up. The builders are starting to participate. We need that inventory. And those people who are reluctant to sell for whatever reason, if it's underwater equity, and by the way, we didn't talk about that, but underwater equity is corrected over time as price increases. So I think if you look at CoreLogic, that produces some pretty interesting data on this, about 2.3 million people this year will come out of their underwater equity position. They'll move back into the money. They'll be available to offer new inventory to the marketplace. So all those dynamics are playing out. And if you think about it in the broad sense, between now and next year, between Fannie and NAR, both are forecasting 24% volume over the next 2 years. 14% of it this year and about 10% of it next year. So in spite of all these issues, the market's working and housing is recovering. So.
And I'd like to get back to the supply issue that Jerry mentioned. When you just add up all the single-family homes, multifamily apartments that were built, manufactured homes that were placed over the last 10 years, the extent to which the correction reversed what was a very high level of production is dramatic. So when you add it up over those 10 years, it's something around 13.5 million total units. That's the lowest 10-year count we can see going back to the 1974 to 83 period, which is the furthest back we can go, in an environment where you would expect the total amount of construction to actually be higher because the country's obviously a lot larger than it was then. You have the echo baby boom coming into the market that's been, you know, doubled up. You have at least a couple million households that are living doubled up. They're just waiting for that moment, you know, all clear to get out of the parents' basement, or their parents want to get them out of their basement, or wherever they are in their home. Eventually that's going to happen, and I think we're getting very close to that point. For the new construction to keep up with just the household growth right now, it's below household growth right now. So it's got a long way to go before it's going to actually get back to a normal kind of 10-year rolling average of construction. So I do think markets are going to remain tight, and they're all over. I mean, building takes place all over because there's natural population growth in most parts of the country, and right now they're just not building even to keep up with that. So I think
what's
that's
really frightening
an important
about
part
that,
of
Eric, is the
markets.
fact that while the housing markets are all individualized, the bank regulations are national. And so the same constraints that are put on building where there still may be an excess of supply already in the ground are put on builders who are in markets where they actually need new housing now. And so you could have a disparity in the overall national market. In some places, a housing bubble caused by a lack of supply, and in some places, not enough demand to eat up the inventory that's still there. It's going to take a while for equilibrium, but it's got to start with some reasonable financial regulation.
Well, and I wanted to ask you, actually, when we talk about financing, the key is getting that very important cohort of demand back into the market, which is the first-time home buyer, which has been really hit by financial regulation in the mortgage industry and by, you know, mortgage credit availability. What is it going to take to get that first-time buyer back into the market?
Well, let me preface it with, because I wanted to make a point about supply too, which is to keep in mind that supply-constrained markets are behaving very differently than unsupply-constrained markets. It's hard. We never have fixed the problem of it's incredibly difficult to build in San Francisco. So I don't see a lot of supply coming onto the market in San Francisco anytime soon. And also, you know, we've talked about Phoenix, but you compare Phoenix to San Diego, which is of equivalent population size. The last couple of years, Phoenix still is building twice as much as they are in San Diego. So again, some fundamental supply differences that were there before the bubble and are there now are still important. But getting the first-time buyer back in, I think in some of these markets, you know, again, look at San Francisco, where a median house price is almost 8 times median income. You know, the first-time buyer is really just going to have to stretch. You know, whether you so it's not just issues like down payments; it's also debt to income, which is going to be a big constraint under QRM. So I'm fairly skeptical that unless we see some pretty big changes to QRM and QM and these things, that you're going to have first-time buyers come back in places like San Francisco. I'm not worried about Phoenix or Houston, quite frankly, because I do think that the prices will get to a point where a first-time buyer can afford, under normal underwriting circumstances, to get a home there. It really is a point of, you know, are you comfortable with where you think prices are going? I think a lot of first-time buyers, I mean, I guess there's a couple elements. A lot of first-time buyers are in age groups that have looser attachment to the labor market. So, you know, this part of this is traditional pent-up demand. You've been at your parents, you don't have a job. When you get back into the labor market, that demand is going to start to come back. So I think we should emphasize the labor market's a key issue with this. And now that we've started to see some stabilization, I'm not incredibly hopeful. I will say I don't think the labor market's going to get a lot worse, but I also don't think it's going to get a lot better anytime soon. That's going to be a governor on first-time supply probably more than anything.
I think consumer psychology is key here, and I think they're coming out now. I mean, the bottom line is there are a lot of people living at home who had jobs and just, you know, were frightened out of the market. Now they're seeing a market that's going up. They're seeing an opportunity to buy at these low rates with prices going up. And the employment growth, while it hasn't been as strong as we'd all like to see it, it has been steady, and it's been going on for a number of years. So there is that demand. I think it goes back to Johnny Isaacson's, Senator Isaacson's comment about is this going to be a 60-watt recovery or a 40-watt recovery or a 100-watt recovery. There are a lot of headwinds to it being a 100-watt recovery. It's a strong percentage growth recovery, but in absolute terms, we're starting from such low levels. We're still getting up to levels that are below anything that looks like what we think would be a normal level of construction, normal level of new home sales. normal level of existing home sales. So I think we're still a long ways from there, but I do think first-time buyers are coming out, and I think parents are saying, now's the time I'm going to write you a check for that down payment. Go for it, because I think this is the right moment.
I don't know. I guess I really am interested in seeing how this plays out, because if you look at the cohort of young Americans who got hurt so badly by the Great Recession, I mean, they took the majority of the job losses, the long-duration job losses, the wage losses by that cohort were as large as all previous post-war recessions. This was an enormous financial hit. And I don't think they believe the story that I was told growing up, which is, you want to accumulate wealth, you buy a house. It's the only thing that'll never go down. That's sort of hard to make that case now.
Well,
and so
Senator
we'll
Isaacson just said it's always better to buy
I would
than
never
rent.
disagree with this city senator, ever. Is he still here? We'll see. I mean, if you look at the mechanics of interest rates, credit availability, income growth, if those all went back to what they were, that'd be great. But will the labor force attachment be what it was? So far, no. Will the attraction of homeowning for other than the space to live in be the same as it was? I don't know. I think those are important questions going forward.
I think you're right,
Home
but there's-
ownership is always, based on home price appreciation. I mean, there are two things that drive home ownership. Number one is marriage and kids, and number two is the idea that you're making an investment that's going to grow, and it's going to be your single largest investment. And both of those have actually, not just the investment part, but we've seen marriage rates come down. We've seen birth rates come down during the recession. And so those first-time buyers are not in the numbers that we would have seen them perhaps even 10 years ago.
Home ownership in this country is aspirational, always has been, always will be. So this thought that we're going to drop to the low 60s and stay there is just, I think there's no basis for that. Look at the European Union. European Union average home ownership rates are around 67, 68%. Bulgaria is at 94%. I mean, we are not in the market where we should be. The home ownership rate dropped to the 65, not out of choice. If you inventory the people who lost homes, their first purchase they would make, if given the opportunity, would be the next house. And there are a number of, CNBC did a research report in January, and I think Pew.
The boomerang buyers.
Yeah, and Pew did one in March. And I think the Pew research indicated that of those surveyed, 81% said, I think home ownership is a part of the American dream, and that's what I aspire to do. So we don't worry about that. I think there are some data points that are very telling. I think the Harvard Joint Center for Housing Studies recently did a study that there are 20 million renters now qualified to buy a home, and that's today. In 2005, that number was 9 million. So there's enormous pent-up demand from the renter community to move back into housing if given the opportunity, and I suggest that eventually they will. There are a couple third parties. I think Zillow does some work along these lines. Trulia and a few others have done work. Of the 100 markets tested, it was cheaper to own than rent. Now, that hasn't always been the case, but of late, that is certainly the case. So, listen, it's all lining up to more people will move back into the market if they can afford it. So that plays out over time.
And qualify.
And they got to qualify.
I would say there's two aspects of this issue. There's the will and the way, and I think when you look at the will just seems completely undeterred. We used the Fannie Mae survey, which is a very good survey, where they ask homeowners, and renters a whole bunch of questions, and 19 out of 20 people under the age of 30 say they expect to buy a home at some point in the future. That's 19 out of 20. And when you ask, what proportion of them think that owning essentially makes more financial sense than renting, it's 80%. So I think the will is there. The bigger issue, which we've talked about and danced around, is the way, and the way is definitely much harder. Incomes are lower, as we said, but mostly it's the credit underwriting standards, which have swung so far in the other direction that a lot of people who have the will don't have the way, or they think they don't, and they're not going to apply for a mortgage because they expect not to be able to get the mortgage. And when you look at the average credit scores that are going out now through FHA, even 710 average credit score, there's just a whole part of the market that we normally would have thought of as a very insurable part of the market that would lead to a level of expected defaults that isn't severe, who can't get into the market. So that's why I do think this recovery is going to continue on, but it won't be as strong as it might have been if credit standards were different and if job growth were stronger.
Which gets to Senator Isaacson's point that if Congress or policymakers fix the mortgage markets, the recovery will be stronger. Not only the recovery in housing, but the recovery across the entire economy. It's sort of a chicken and egg question, but I agree with Eric that right now people, and with Richard, people still do want to own their own homes. There's no question. When we poll and survey young people, immigrants in particular come to this country with the dream of owning a home. And there's nothing that underscores the aspirational more than the immigrant population. But the ability to get a home is so constrained by the credit right now that it's holding back the recovery and holding back the whole economic recovery.
Well, I do want to get to one more point, and bouncing off credit there, is the distress that still remains in the market and within, and that's pressuring the credit market as well. And, you know, we tend to, it's strange because I go to a lot of these conferences, and a year or two ago it was all about the foreclosures, it was all about distress, and now it's all about credit and all about moving into the future. And we forget that there are still 5 million delinquent loans out there in some stage of either in the foreclosure process or seriously delinquent or just partially delinquent. That's 5 million loans that are still there. Now we can say, oh, the banks are, you know, lowering principal, we're getting more people into aggressive modifications, we're doing more short sales, but that distress is still there. Not to mention the people who have already lost their homes who might like to get back into home buying, and how long is it going to take them to restore their credit? When we talk about the future of housing demand, where do you see the continued distress in the market and those buyers who want to get back in? When do they come back? Because you start hearing the word boomerang buyers now, that people after even 3 years are starting to get back in, and others saying it's going to take 7 to 10 years.
Well, the good news is it's not a static environment. So all that aside, there are 1.2 million new households created every year. 65, if history repeats itself, it will, 65%, 66% of those people will be homeowners at some point. So it's a very fluid, ever-changing market. As you have people sitting on the sidelines for all the reasons you've indicated, you have a whole new crop of prospective homeowners forming every year, and that's the market. That'll keep the market very viable and very fluid and very dynamic. And you know, it's what the market will bear.
This huge
right?
pipeline of foreclosure still coming. You don't think that's going to affect?
Remember, anything originated since 2009 is pristine. If you talk to Fannie and Freddie, the loans the default rates are extraordinarily low. The senator is absolutely correct. And if you look at those loans, they're performing incredibly well, and it's very unlikely that they're going to default. So the 5 million, will all of them fail? Probably not. Will half of them fail, not get short sales, not get workouts? So you got 2.5 million units sitting on the sidelines in some state of disarray. That's not going to have a material impact on a much broader market.
It's a major concern, I think, obviously, when you see that many people who are in distress and there's that many units that are working their way through a foreclosure process. And when you look at the actual geographic distribution of these things, they're obviously quite lumpy, and they're heavily concentrated still in low-income communities. And for those communities, it represents a serious issue. You know, we call them the hardest hit communities. You know, the federal government had a program, Neighborhood Stabilization Program, $8 billion, when you consider that probably $500 billion has already been spent dealing with units that have already gone through the foreclosure process. That's like a teeny amount. And so those communities are of serious concern, and it's really hard to imagine how credit comes back to those kinds of places in a way that is any quicker, but likely slower than the slow pace it's coming back in other places, because the level of vacant units, abandoned properties, some have been foreclosed, some are in the foreclosure process and abandoned. Another company came out with a number of quote-unquote zombie properties, you know. But it's a serious issue, but it's an issue for particular neighborhoods, some still communities, but especially neighborhoods across the country.
Well, I certainly agree with everything Eric just said, but I want to emphasize a different facet of it, which start with the observation that the number of the percent of households entering foreclosure for the first time sort of, you know, peaked in 2009. Right now, the majority of households entering foreclosure were in foreclosure at some point before. And so we're getting to the point where we've basically churned and churned the same households. So my point being is that my concern is that we have a greater percentage of households in which the ultimate cure rate is going to be a lot less without some sort of bigger intervention. That we've basically sort of picked all the low-hanging fruit in terms of households that we could get through foreclosure or keep in the house or do something else, and we've gotten more and more a core in which there are very severe problems. So I think that that's going to characterize, again, hit particular communities very hard, but much harder question to fix. I do want to say, as an aside, you know, going back to an earlier question about what Doug mentioned, sort of about price appreciation. You know, my back of the envelope back in 2006 was about 85% of borrowers in 2006 had been around as a homeowner during the last boom and bust. So I guess a couple points I would make is never underestimate the ability of the American public to forget that asset prices actually come down. And so I'm very confident in I'm very confident in my lifetime that I will see another boom and bust in the housing market that will end very badly. I have no doubt about that, and I think it'll be sooner rather than later.
Cyclical industry, so.
It is. But then when we talk about that demand again going forward, because I want to keep this in the future, how do we get the people who have already lost their homes back into buying?
Well, they're repairing their credit much faster than you might think. I mean,
I'd like to get a
3
touch
years.
on that. What are you seeing?
With 3 years, we're seeing people come back into the market 3 years with FHA financing. Now they've had to work really hard for 3 years, but it's doable, not in every instance, but it's certainly doable. And I think it's remarkably short from a period of time that you would think would need correction. But 3 years is, we're seeing a good.
I think you should turn the question around and just ask yourself how fast you want to get them back.
Yeah,
because this is all a policy
It's
issue.
all policy.
We're doing it with the FHA. We're trying to decide with the QRM standards. We got the Basel thing floating around. I mean, all of this is driven by policies which have yet to be anchored. What's the future of Fannie and Freddie? We can get anyone back in tomorrow if that's becomes the policy objective. That's the discussion. And that's actually the thing that's hanging over all of this, which is all of the rules of the road remain unsettled, and that's not helping. I mean, this is all there is to it.
And let me emphasize as well, I mean, the point was made. I mean, it is FHA that is getting the borrower who's got a dinged credit with very little down.
But they're raising premiums. I mean, they're keeping
Absolutely.
people out.
And at some point, it's hard for me, you know, once the rest of the market starts to come back, it's hard for me not to see them adverse selected. You know, if you're going to be a good credit borrower, are you going to be willing to pay the premiums that FHA is going to be charging in a year or two? I would say no, and then it raises the question of can they maintain the credit quality they have had, and if they can't, you know, then they're going to find themselves needing lots of money. Then where are we in a policy space? So again, all of this is unsettled. You know, the question of whether FHA is sustainable on its current path is to me a very open, debatable question at least.
But we've kept one. We haven't said one thing about the return of the private securitization market, which is, you know, we've talked to a lot of investors out there who are, as we speak, gathering their cash and getting their ducks in a row and getting ready to offer. Obviously, they're still waiting for rules of the road as well, like the rest of the banks, but they're ready. Do you believe
Right
the
now,
private, are they coming back?
These are the
because they
squeakiest, cleanest mortgages you ever saw. I mean, they'll have, you know, 60%, 70% down payments, you know, 780 to 800 credit scores.
Which you would think would bring lots of financing back in, right? Why is it not
Sector
there yet?
especially.
It's as I say, at a certain pricing point, they'll come back into the market, but for not the mass middle market. They'll be at the very pristine loan level. And so far, it hasn't happened. You can kind of see it. What has happened is FHA premiums are going up to an extent that's great enough for the Fannie Freddie execution on a 10% down or a 5% down
And that's
loan
helping the
actually
private
work.
mortgage
So
insurance.
they're starting to come back, but that certainly I wouldn't call a private securitization market.
So certainly echo that I think the private securitization market, which I think will come back sooner rather than later, will be limited to pristine borrowers. You know, but I want to make what I think a counterintuitive argument here about one of the other potential sources is bank balance sheets, and of course we need to get the Basel rules. We need to figure out what those are going to be. But I would submit that there's no way in the world that I would make a mortgage at 3.5%, 4% and hold it on my books when I think interest rates are going to go up, and over the life of that mortgage, there's just too much interest rate risk embedded in it. So I'm going to make maybe the contrarian argument here that when we start to see mortgage rates go up to a level where the interest rate risk for portfolio lenders is reduced, I think there's going to be a greater willingness to actually make those loans and portfolio them in a way we're not, and hold them in a way we're not seeing today. But again, very contingent on what gets parsed out in terms of capital.
And I
So
know
you're
that's
blaming the Fed for the lack of the return
Absolutely,
of the
I
private securitization
think the Fed has
market.
forgotten
I got
that
it.
it's not just demand, it's supply.
I think this is the next panel, so I don't want to go into the next panel's realm. Keep that there. I do want to, however, open up the floor to any of y'all who would like to ask questions. I don't know who's got a microphone, or because I was told to do that right around there.
Some on your left, too.
Got two dueling ones.
Yeah, hi, Tom Lawler, some old guy from Leesburg. I sense that there may have been a little disagreement on the role of investors over the last few years in the single-family market, and I just wanted to give a little data and color. You know, from the standpoint of government data, although it's not very good on housing, the fastest growing rental part of the market has been single-family detached. Over the last 5 years, there's been an increase of well over 2 million in the number of single-family detached homes that are now occupied by renters. And the biggest increase is, you know, you hear about the Blackstones or whatever of the world, but the biggest increases that came was actually 2010 and 2011. And it wasn't mom and dad buying a home for the kids, it was mom and pop investors. So this has been going on for a while.
Exactly.
And just also from the standpoint of even more recently, I'm just going to read off the all-cash share of home sales through MLS, either our property records of a few areas. This is for March. Phoenix 42, Vegas 57, Toledo 39, Detroit 46, Sacramento 36, Southern California 34, Orlando 55, Knoxville 27. And I only have the February data for all of Florida. Single family 51, condo townhome 77.
So I totally agree with what Tom's saying. That's why I was a little surprised by your numbers on, and I didn't know if you were talking about institutional investors or
institutional investors.
See, so what he's calling mom and pop is your mom and pop investor. Right. This is why I said it's about, by our estimate, about 2.5 million units, single family existing units, have gone from being owned to being rented between 2007, 2011, even more in 2012. But it's mom and pop, it's a fragmented industry, and they're moving them onto the rental markets. Some of them, however, are very quickly turning around, because a lot of these are in really distressed condition, turning around and they're resold. So if you look at, you know, a couple other data sources that look at the proportion of these things that have been bought out of foreclosure and then resold again within like a year or two, it's a non-trivial amount. So of the 5 million homes that have been bought out of foreclosure, my best guess is, and Tom's right, federal statistics are not great in this area, about 2.5 million have ended up in the rental market, 2.5 million have been bought largely by cash buyers who have fixed them up and marked them up because they've improved the unit, plus it's no longer a distressed sale, it's an arm's length sale.
Just for the record, we don't care why you have to sell, we're happy to accommodate every single reason. So, Santa Barbara, California, largest reason to list is divorce. So we're sorry about the divorce, but we're happy to help you sell the house. But I was speaking to the cottage industry has been alive and well for decades. I mean, I used to participate in that when I was in college. You buy a house, you put it in the market, you rent it. 20 years later, you've done fairly well, all considered. It's the institutions I was speaking to. They've had far less of an impact than all of us would have been led to believe. But mom and dad have been buying homes to put back into the rental market for decades, and that's a good, healthy component of the market.
And I estimate, you know, it's about $490 billion probably from those guys, roughly, and 10 to 20 billion from institutional investors. So they are a small part. They've been getting the headlines, but it's the person that sees the opportunity, who's local in the market, and they buy 4 or 5 units. Some of them only buy 1 unit, some buy 2. And they're planning on holding it and renting it out. If the market improves that much, one risk in a place like Phoenix, frankly, is at some point some investors are going to go, wow, this was all upside for me. I'm already 25% up on price appreciation, and I'm going to head for the door maybe before the other guy does. So I think there'll be some things that slow appreciation. This is to Stan's point. So that if you don't see appreciation slow in some of these markets over the course of this year, I'd be more nervous a year from now. But there's a lot of reasons to expect that you're going to see some more supply come on and some demand come off as prices go up to that degree.
I think this is a really interesting question if you care about now to say mid-2014. I don't know what the right horizon is. But if you really care about the longer term look, the end game for those investors is the consumption demand for housing. And that's the issue that's unresolved, I think, at the moment. And the flip side to this phenomenon is the rental market. And what they're going to be able to move that for is going to depend on this big increase in rental supply. And I think that cannot be underestimated in trying to see how this plays out.
I was going to ask, do any of you guys track the rent-to-own programs that investors have set? Because I think that has a potential impact on the market.
It's small.
Tiny.
It's been small. But I do think that this issue of just an overall supply, the reduction in the rate of growth of the overall supply of the housing stock obviously matters over the long run, because housing is partly going to be set just by the cost of providing it, replacing it, what we call replacement demand. All those things tend to go up over time. You tend to have inflation when you net out periods of oversupply and undersupply and dramatic drops in demand from great recessions, things like that. There's been a secular increase in these costs. There's some argument around the data as to how much, but I think it's greater than some people believe. And that's why people are shelling out more and more of their income from housing. They want housing. They understand all the benefits they get from housing, whether they own or rent. And that's why you're starting to see the share of what we would call cost burden households has been going up since 1960 almost uninterruptedly. And that's part of the fact that incomes just aren't keeping up with the rate at which the cost of housing to provide has been going up.
Yeah, could I just plant a seed? This is something for you to think about. There's a reason it has always been a cottage industry. It is a very difficult business to manage. Multifamily is one thing. Everything's fairly cookie cutter. It's very vanilla. It's vertical. It's easy to manage. But when you have 5,000 homes from Southern Cal to Northern Cal, it's an entirely different management issue. And mom and dad have been terrific at managing that. I'm not so sure the institutions are going to find that to be an easy task.
Let's get a question over there.
Yes, Lee Stevens from BNY Mellon. You've spoken a lot about factors that are going to affect the future, income, interest rates, credit. I wonder if you could speak a little bit about demographics. I was at a conference last week where Dave Stevens from the MBA spoke. He actually referenced some of your work, Dr. Belsky, where you were talking about the echo boom and how the demographics may impact housing in the future.
So obviously one of the key demographic drivers in our view is the increasing diversity in the American population. If you assume there's no immigration and you assume that headship rates stay about where they are by age, you get about 10 million households forming. If you get immigration that's along the lines of what the census now predicts, you'll get something more like 12.5 million. If you get to a higher level of immigration, something north of that. But because of past immigration and likely future immigration, our best guess is that the 30% of the population, which we now call minority, is going to account for about 70% of household growth over the next 10, 15, 20 years. And by somewhere out around, it varies, somewhere out around 2045 or somewhere like that, what we now call groups in the minority are going to be groups in the majority. So that's a big one. The other really huge two are the baby boomers, who were much larger than the generation that was ahead of them, are moving into their late 50s, 60s, and early 70s. That's going to drive about a growth over the next 10 years of close to 11 million households more in that age range. That's an enormous growth. And over 75, largely due to longevity gains, another 2 million there. We're actually going to see a hollowing a little bit in people in their 40s and 50s. That should shrink by a couple million. And then people in their 20s, 30s, about flat. So, but the echo baby boom that's come in was a very strong driver of growth and will be starting to move forward. And that size of that generation right now is about 85 million. The baby boom at the same ages was about 78 million, 77, 78 million. So it's even larger than the baby boom. What makes it different is when the baby boom came up, they were like a huge thing, sort of the Python kind of thing. They were a huge thing moving up the age distribution. But now things look more like a column because immigration has backfilled so much. So while the echo baby boom, is a big generation, it's a little wider now at the bottom of the population pyramid, the younger age group. But we pretty much, now look more like a column. And this is what's going to just keep producing, housing demand of about what we've been seeing, provided that the economy, stays on track. The biggest concern that, we haven't talked about, obviously, is, are we past the abnormal? Are we in a new normal, or have we not gotten back to what a lot of us think will just be kind of a normal? And if we do, then those demographic factors are going to drive a level of demand that is, not dissimilar from the 90s.
Well, just to follow up on that, there's been a lot of talk recently, especially among the home builders, about multi-generational living, and that how immigrant populations are moving in, and that their cultures are more toward multi-generational living, and you're seeing that in a lot of the product that the home builders are putting out. is that a very small blip on the radar, or is that going to affect the household formation that you see if you have, parents moving in with kids?
I think that in our surveys of our members, they are planning on it being more than a blip on the radar screen, that it will become a part and parcel of American life to have multi-generations, and they're planning for it.
I do think it speaks to the importance of immigration. I don't think you can overestimate the point. And obviously, it's a big debate right now, and we can dictate in many ways the quality of not just the labor force, but the characteristics of housing demand from a demography point of view in making our immigration reform choices. It's central.
Yeah, it's the big, what we call the wild card in the level of overall growth in demand and therefore new construction. And as I said, it causes a swing from somewhere between, an estimation of around 10 million to something more like 13 million. That's a third, potentially, as much if immigration returns to levels that look more like the 90s again.
The other component of that, Diana, is aging in place. A lot of people are building now with homes that are going to be adaptable so that they won't have to retire to other places and they'll stay in place. That will impact demand going forward, too, to some extent.
But we're seeing less confidence in the 55-plus active adult communities than we're seeing in the overall when you look at your home builder confidence indices. Why is that?
I think it has to do right now with people not ready to move into those places. I think people in the over 55 area are staying put. Some of them are remodeling to age in place in their current homes just because they don't want to make that kind of a drastic commitment.
But I think when you ask, and Zillow would probably confirm this, when you look at what people are searching on, they want bedrooms on the first floor, they want a full bath on the first floor. So I think where baby boomers are coming from is some will move to age-restricted communities. But I think there's this broader, larger, understanding, dawning awareness that, hey, if I'm going to be moving into my next home and I'm in my 40s or 50s, I may very well stay there for the rest of my life. I want to be prepared to have a place where I can age if I start having some kind of mobility limitation. That's why I think that's going to become a very significant thing. And I think, frankly, it's going to be a premium in terms of existing homes and their ability to price up to something that the market wants. They want, certain things that used to just be a sizzle in the kitchen. Now it's open layouts and some ability to age and gracefully in that place.
I think we have time for one quick question left.
Hi, my name is Ben Clemens. I'm with the Census Bureau. I've already been handed the mic. So this is kind of a follow-up to that question. At the Census Bureau, we have a couple of questions about where did you live at this address last year, and answers to that. The percentage of people who moved in a given year has been ticking down steadily for decades now, back into the 1900s. And so, I'd like to hear your thoughts on, first, why that is, and second, if this trend continues, how that's going to affect housing demand.
I don't know who that was directed at.
Or if you think that trend will continue.
So that was a really hard question. What's the next one? I think overlay everything that you've heard about that with the second great trend in America, which is urbanization. And what you saw was a lot of moves to cities, and as people got into urban areas, it lowered the sort of move rate because they were already in big urban areas. And I think that's even though everyone talks about the suburbs and the exurbs and all that other stuff, the reality is we're becoming more urbanized every year, and the projections are we will become more so. And so
urban
that's
cores
there.
and urban condos, urban centers are
part of this deal.
recovering a lot faster
big part
than
of
the
this deal.
exurbs are.
So I made that answer up. I don't know if it's right.
The reason for the we've looked at this, and it's declining by age, and Tom could probably comment on this as well, Tom Waller. But different data sets are telling us different things, but they're all showing this secular decline, and it's not entirely clear exactly why we're seeing that. It doesn't show up, obviously, in new home sales numbers and existing home sales numbers. That's really been more driven by market factors and the overall size of the population. But you would expect it, if it continues at some point, obviously, to slow the rate at which rental units are turning over and homeowner units are turning over. But it's hard to pin this down, and different data sets give you different kinds of pictures of what's happening.
Make a couple of quick points. I mean, and certainly I think the demographics are part of it. I mean, the population aging is certainly a driver of that. One of the interesting things about this cycle relative to other cycles is in previous housing downturns, the homeowner mobility actually went up relative to the other cycle. In this cycle, it's gone down. Now, I would argue that part of that is programs we've encouraged people to essentially wait out the process rather than to try to move on and do something else with their lives. That's one aspect of it. But again, the other part of it is I do think that you have to look at differences between interstate and intrastate mobility, and I think those have been slightly different trends in that you have more options within the same county, same state than you would have otherwise. It's not like you feel like you had to go west, young man, to get a different change. So some of that matters as well.
I suspect employment has a certain impact. I mean, there's a lot of mobility that's employment related, interstate and intrastate. So I suspect, that, although not knowing, because never looking at the data, I suspect that a great deal of that pertains to employment and the likelihood of employment outside of your current job. So.
I'm afraid we're getting the hook here, but I'd like to thank you all for joining us. It's been a great panel, some really interesting stuff. So
thank you.
Thank you very much.
That was fun.
Good to see you.